Second aspect of ratios, or the second type of ratios that we are going to discuss, are profitability ratios. Now, the profitability ratios, profitability is about performance. So, normally we talk about three different types of profitability ratios under normal circumstances. That is, we start with gross profit margin. Gross profit margin is gross profit over sales into 100. Now we arrive at a gross profit by taking away cost of goods sold from sales. So sales minus cost of goods sold is gross profit. In case it's not given, we calculate it. So gross profit over sales into 100. Sales is sometimes also called sales revenue or sales turnover. So we don't need to get confused with different terminologies or alternative terminologies which are being used. So the formula is gross profit over sales into 100, and this is how we calculate gross profit margin, which is the first profitability ratio. Now, unlike liquidity ratios where we have given standards, we do not have any standards over here. We just compare the current value of gross profit margin with the previous value, and we can also compare the current values with the values of competitors, that is if they are available, and the industry as a whole as well, in order to find out whether we have improved in terms of profitability, or the profitability has declined. So if we are doing better than previous year, obviously we are moving in the right direction. If we are doing better than our competitors, we are moving in the right direction. If our if our answer is better than the industry average, we are moving in the right direction, we are doing well. The second ratio in profitability ratios is net profit margin. Now, net profit margin, sometimes we also calculate it as operating profit margin. Now, net profit before interest and tax is basically what you call as operating profit. So operating profit over sales into 100. That is how we calculate operating profit margin or net profit margin. Again, we are not going to discuss any standard values because it differs from industry to industry. Each industry is going to have its own profitability values. Obviously, different industries tend to have a different potential in terms of profit maximizing or profit maximization. So, that is something which needs to be considered while trying to arrive at a standard. We cannot really arrive at a standard that easily, especially there's no general standard available. Again, if you are doing better than the previous year, you are good. If your net profit margin is better than most of your competitors, you are good. And if it is better than the industry average, again, you are moving in the right direction. The third ratio which we normally come across while talking about profitability or performance ratios is return on capital employed, ROCE. Return on capital employed, it is operating profit over capital employed into 100. Now, the capital employed is sometimes calculated by adding non-current liabilities with shareholder funds, or sometimes it is also called net assets, which means that if we take away current liabilities from total assets, we can reach the same value. So capital employed is either calculated by adding non-current liabilities to capital, or it is calculated by taking away current liabilities from total assets. So this is how we calculate return on capital employed. Return means profit. So profit on the total investment made into the business is what we are trying to calculate. Obviously, higher the profit, the better. That is the case with all the profitability ratios. Again, we can compare ourselves in terms of profitability with our previous performance, with our competitors, and with the industry as a whole. Thank you very much.